Good day, participants. Welcome to the second part of Integrated Reporting, International Framework, which focuses on Chapter 3, the 7 Guiding Principles. These principles form the conceptual backbone of an integrated report and guide not only what information should be reported but also how that information should be presented to stakeholders. The framework emphasizes that these principles must be applied both individually and collectively, requiring professional judgment whenever tensions arise between competing considerations such as conciseness and completeness. The principal topic of this slide is the 7 guiding principles of integrated reporting. These principles establish a coherent structure that enables organizations to communicate value creation in a balanced, connected, and decision-useful manner. They ensure that reports move beyond traditional financial disclosures and provide insight into strategy, governance, performance, risks, opportunities, stakeholder relationships, and future prospects. The key subtopics include strategic focus and future orientation, connectivity of information, stakeholder relationships, materiality, conciseness, reliability and completeness, and consistency and comparability. Together, these principles provide the foundation for preparing integrated reports that are transparent, credible, and aligned with stakeholder expectations. Another important aspect is the requirement for integrated thinking, whereby organizations consider the interrelationships among governance, strategy, risks, opportunities, performance, and the 6 capitals. Through this approach, reporting becomes an extension of organizational decision-making rather than a separate compliance exercise. As we progress through this chapter, it is important to recognize that these guiding principles are not isolated reporting requirements. Rather, they collectively establish a framework that supports sustainable value creation, strengthens stakeholder confidence, and enhances the quality and usefulness of corporate reporting. Slide 2 is to 3a, Strategic Focus and Future Orientation. This slide introduces the first guiding principle, Strategic Focus and Future Orientation, which requires organizations to provide meaningful insight into their strategy and how it supports long-term value creation. The principle emphasizes that integrated reporting should not merely describe historical performance but should also explain how current decisions influence future outcomes. The principal topic is strategic focus. An integrated report should clearly explain how the organization's strategy contributes to its ability to create value over the short, medium, and long term. It should demonstrate how strategic priorities are linked to the organization's use of and effects on the capitals, thereby enabling stakeholders to understand the rationale behind key decisions. A major subtopic is significant risks, opportunities, and dependencies. The framework encourages organizations to highlight material risks and opportunities arising from their market position, operating environment, and business model. These disclosures help stakeholders evaluate future resilience and competitiveness. Another important subtopic is governance perspective on future performance. Those charged with governance should provide insight into the relationship between past and future performance, including factors that may alter this relationship. This promotes accountability and strategic transparency. Additional subtopics include balancing short, medium, and long-term interests and learning from past experiences. Effective organizations continuously adapt their strategies based on lessons learned, changing stakeholder expectations, and evolving external conditions. Ultimately, strategic focus and future orientation enable organizations to communicate a clear roadmap for sustainable value creation and long-term success. Slide 3 is to 3b, Connectivity of Information. This slide explores connectivity of information, one of the most distinctive principles of the International Integrated Reporting Framework. Connectivity ensures that stakeholders receive a holistic understanding of how various organizational factors interact to influence value creation. The principal topic is holistic value creation perspective. The framework requires integrated reports to demonstrate the interrelationships and dependencies among factors affecting value creation. Rather than presenting information in isolated sections, organizations should illustrate how governance, strategy, performance, risks, opportunities, and capitals are interconnected. A major subtopic is content element connectivity. Integrated reports should connect all content elements into a coherent narrative reflecting the dynamic interactions of organizational activities. This provides stakeholders with a complete picture of how the organization operates and creates value. Another important subtopic is past, present, and future linkages. Historical performance provides context for assessing current capabilities and evaluating future prospects. Understanding these temporal connections enhances stakeholder confidence in reported information. Additional subtopics include connectivity among capitals, financial and non-financial information, and quantitative and qualitative information. Organizations should explain trade-offs among capitals, connect financial performance with broader sustainability outcomes, and integrate narrative explanations with key performance indicators. The framework further emphasizes that connectivity is strengthened through logical report structure, clear language, effective cross-referencing, and strong integrated thinking embedded within organizational processes. Through connectivity of information, integrated reporting provides a comprehensive and decision-useful understanding of organizational value creation. Slide 4:3C, Stakeholder Relationships. This slide focuses on stakeholder relationships, recognizing that value creation does not occur solely within organizational boundaries. Sustainable success depends significantly upon the quality of relationships maintained with key stakeholders. The principal topic is understanding and responding to stakeholder needs. An integrated report should provide insight into how the organization understands, considers, and responds to the legitimate interests and expectations of its stakeholders. This demonstrates organizational responsiveness and accountability. A significant subtopic is value creation through relationships. The framework explicitly recognizes that value is created through interactions with customers, employees, suppliers, regulators, communities, investors, and other stakeholders. Consequently, the quality of these relationships directly influences long-term value creation. Another important subtopic is benefits of stakeholder insights. Stakeholder engagement helps organizations understand perceptions of value, identify emerging trends, detect material risks and opportunities, evaluate strategic alternatives, and improve decision-making. These insights contribute to stronger governance and more effective risk management. Additional subtopics include transparency, accountability, and trust. Regular stakeholder engagement enhances transparency and accountability, which are essential for building organizational trust, resilience, and legitimacy. Accountability is closely associated with stewardship, the responsible management of the capitals affected by organizational activities and outputs. Ultimately, stakeholder relationships are not merely communication channels. They are strategic assets that contribute significantly to organizational sustainability, resilience, and long-term value creation. Slide 5:3D, Materiality. This slide introduces materiality, one of the most critical principles within the International Integrated Reporting Framework. Materiality ensures that an integrated report focuses on matters that substantively influence an organization's ability to create value over time. The principal topic is material matters and value creation. The framework requires organizations to disclose information regarding matters that significantly affect their ability to create value in the short, medium, and long term. Materiality therefore acts as a filter that determines what information should be included in the report. A major subtopic is the materiality determination process. The framework outlines a structured process consisting of 4 stages: identify matters, evaluate importance, prioritize matters, and determine disclosure. This process ensures that reporting focuses on the most significant issues affecting organizational performance and future prospects. Another important subtopic is positive and negative matters. Materiality applies equally to risks and opportunities, favorable and unfavorable performance, and both financial and non-financial information. Organizations are expected to present a balanced view of matters affecting value creation. A further subtopic is integration with management processes. The materiality assessment process should be embedded within organizational management systems and supported by regular engagement with providers of financial capital and other stakeholders. Through rigorous materiality determination, organizations enhance the relevance, transparency, and decision usefulness of integrated reporting. Slide 6. Materiality, identifying, evaluating and prioritizing. This slide expands upon the materiality determination process by explaining how organizations identify, evaluate, prioritize, and disclose material matters. These activities ensure that integrated reports focus on issues most relevant to sustainable value creation. The first principal topic is identifying relevant matters. Relevant matters are those that have, or may have, an effect on the organization's ability to create value. Their relevance is assessed by considering impacts on strategy, governance, performance, and future prospects. Matters discussed by those charged with governance are generally considered relevant. Importantly, organizations should not exclude matters simply because they are difficult to address. The second principal topic is evaluating importance. Not all relevant matters are material. A matter becomes material when its known or potential impact on value creation is sufficiently significant. Evaluation involves assessing both the magnitude and likelihood of impact. The framework recognizes that qualitative assessments may sometimes be more appropriate than quantitative measurements. The third principal topic is prioritizing important matters. Once important matters have been identified, they are prioritized based on their relative significance. This process helps management focus reporting efforts on the most critical issues. The final principal topic is determining information to disclose. Professional judgment is required to determine the nature and extent of disclosures regarding material matters. Effective disclosure considers both internal and external perspectives and is strengthened through regular stakeholder engagement. Collectively, these processes ensure that integrated reports remain focused, balanced, transparent, and aligned with stakeholder decision-making needs. Slide 7. Materiality, the reporting boundary. This slide examines materiality, the reporting boundary, a fundamental concept that determines the scope of information included within an integrated report. Establishing an appropriate reporting boundary ensures that stakeholders receive a comprehensive understanding of factors affecting the organization's ability to create value over time. The principal topic is the concept of reporting boundary. The framework states that the reporting boundary has two interconnected dimensions. The first dimension is the financial reporting entity, which represents the boundary traditionally used for financial reporting purposes. The second dimension encompasses risks, opportunities, and outcomes associated with entities and stakeholders beyond the financial reporting entity that materially influence value creation. A significant subtopic is financial reporting entity. This includes the parent organization, subsidiaries, joint ventures, and associates that are incorporated into financial reporting according to principles of control and significant influence. The financial reporting entity serves as the anchor for integrated reporting because it is the entity in which providers of financial capital invest. Another important subtopic is external stakeholder and value chain impacts. Integrated reporting extends beyond legal ownership boundaries to include risks, opportunities, and outcomes arising from relationships with employees, customers, suppliers, business partners, communities, and other stakeholders. These relationships may significantly affect organizational value creation despite not being directly controlled by the organization. Through an appropriately defined reporting boundary, organizations can present a more complete picture of the ecosystem within which value is created, preserved, or eroded. Slide 8 is to 3E, Conciseness. This slide introduces conciseness, a guiding principle that emphasizes the importance of communicating material information clearly and efficiently. While integrated reports must be comprehensive enough to support informed decision-making, they should avoid unnecessary complexity and excessive detail. The principal topic is concise communication. The framework requires an integrated report to be concise while still providing sufficient context to understand the organization's strategy, governance, performance, and outlook. Conciseness does not imply brevity at the expense of completeness. Rather, it means presenting information that is relevant and decision useful. A major subtopic is balancing conciseness with other guiding principles. Organizations must balance conciseness with completeness, comparability, reliability, and materiality. Effective reporting requires professional judgment to determine the appropriate level of disclosure. Another important subtopic is techniques for achieving conciseness. The framework recommends applying the materiality determination process, following a logical structure, using cross-references, linking to more detailed information where appropriate, and expressing concepts in as few words as possible. A further subtopic is plain language and avoidance of boilerplate disclosures. Organizations should favor clear and accessible language rather than technical jargon. Generic disclosures that fail to reflect organizational specific circumstances should be avoided because they reduce the usefulness of the report. Conciseness ultimately enhances readability, stakeholder engagement, and the effectiveness of integrated reporting. Slide 9 is to 3F, Reliability and Completeness. This slide discusses reliability and completeness, which are essential for ensuring the credibility and trustworthiness of integrated reports. Stakeholders rely upon reported information to make decisions, therefore, information must be balanced, accurate, and comprehensive. The principal topic is reliability. The framework requires integrated reports to include all material matters in a balanced manner and without material error. Reliability is enhanced through robust internal controls, effective reporting systems, stakeholder engagement, internal audit functions, and independent assurance processes. A significant subtopic is balance. A balanced report presents both positive and negative information fairly. Information should not be manipulated through selective emphasis, omission, aggregation, or presentation techniques that could mislead stakeholders. Organizations should provide equal consideration to increases and decreases in the capitals and report performance against previously established targets. Another important subtopic is freedom from material error. Freedom from material error does not imply perfect accuracy. Rather, it means that processes and controls have been applied to reduce the risk of material misstatements to an acceptable level. Estimates should be transparently disclosed along with their limitations and assumptions. The final subtopic is completeness. A complete integrated report includes all material information, both favorable and unfavorable. Organizations should carefully consider the extent of disclosure, future-oriented information, competitive considerations, and cost-benefit implications. Importantly, uncertainty is not a valid reason for excluding relevant future-oriented information. Reliability and completeness are therefore fundamental to stakeholder trust and report credibility. Slide 10 is to 3G, Consistency and Comparability. This slide introduces consistency and comparability, the seventh guiding principle of the framework. These attributes enhance stakeholders' ability to assess organizational performance across time and compare it with similar organizations. The principal topic is consistency over time. Integrated reports should present information using consistent reporting policies and methodologies from one reporting period to the next. Consistency enables stakeholders to identify trends, evaluate performance trajectories, and assess strategic progress over time. A significant subtopic is changes in reporting methods. While consistency is important, organizations may occasionally need to modify reporting approaches to improve information quality. When significant changes occur, organizations should explain the rationale and quantify the effects where practical and material. Another important subtopic is comparability across organizations. Every organization creates value differently. However, integrated reports should be prepared in a manner that facilitates meaningful comparison. Stakeholders should be able to evaluate organizational performance relative to industry peers and broader market benchmarks. Additional subtopics include benchmarking, ratio analysis, and standardized indicators. The use of industry benchmarks, ratios, and commonly accepted performance indicators enhances comparability and improves stakeholder understanding. Standardized definitions established by independent organizations further strengthen the usefulness of comparative information. Consistency and comparability ultimately improve transparency, accountability, and confidence in organizational reporting. Slide 11, Content Elements, Chapter 4, The 8 Content Elements. This slide introduces Chapter 4, the 8 content elements, which represent the core components of an integrated report. These elements translate the framework's guiding principles into practical reporting requirements. The principal topic is the 8 content elements. The framework presents these elements as a series of questions that organizations should answer to explain how they create value over time. Collectively, they provide a comprehensive and connected narrative of organizational performance and future prospects. A significant subtopic is interconnected nature of content elements. The framework emphasizes that the content elements are fundamentally linked and should not be treated as standalone sections. Information should be presented in a manner that clearly demonstrates the relationships among governance, strategy, risks, opportunities, performance, and outlook. Another important subtopic is flexible presentation structure. The framework does not prescribe a fixed sequence for presenting content elements. Organizations may adopt structures that best reflect their circumstances while maintaining connectivity and coherence. The 8 content elements include organizational overview and external environment, governance, business model, risks and opportunities, strategy and resource allocation, performance, outlook, basis of preparation and presentation. These elements collectively form the architecture of an integrated report and provide stakeholders with a comprehensive understanding of organizational value creation. Slide 12:4a, Organizational Overview and External Environment. This slide addresses organizational overview and external environment, the first content element of the framework. It answers the fundamental question, what does the organization do and under what circumstances does it operate? The principal topic is organizational overview. An integrated report should clearly explain the organization's purpose, mission, vision, culture, ethics, values, ownership structure, principal activities, markets served, competitive positioning, and role within the value chain. These disclosures establish the context necessary for understanding value creation. A major subtopic is key quantitative information. Organizations should disclose important metrics such as employee numbers, revenue, geographic presence, and significant changes from prior reporting periods. Such information enhances stakeholder understanding of organizational scale and evolution. Another important subtopic is external environment factors. The framework identifies several external influences that shape organizational performance and strategy, including economic factors such as macroeconomic conditions and industry trends. Market forces including competition and customer demand. Technological factors related to innovation and technological change. Societal factors including demographics, human rights, education, and public health. Environmental factors such as climate change, biodiversity loss, and resource constraints. Regulatory and political factors including legislation and public policy. Understanding these external influences enables stakeholders to appreciate the opportunities, risks, and strategic choices that affect the organization's ability to create sustainable value over time. Slide 13:4b, Governance. This slide focuses on governance, the second content element of the International Integrated Reporting Framework. Governance is fundamental because it demonstrates how leadership structures, decision-making processes, and organizational culture support the organization's ability to create value over the short, medium, and long term. An integrated report should clearly answer the question, how does the organization's governance structure support value creation? The principal topic is governance structure and value creation. Effective governance provides oversight, accountability, strategic direction, and risk management. It ensures that organizational activities are aligned with purpose, stakeholder expectations, and long-term objectives. A significant subtopic is leadership structure. The framework encourages organizations to explain the composition of governing bodies, including the diversity of backgrounds, skills, experience, competence, and gender representation among those charged with governance. Such diversity enhances decision quality and organizational resilience. Another important subtopic is strategic decision-making and risk culture. Organizations should disclose the processes used to make strategic decisions, establish organizational culture, address ethical concerns, and manage risk. These mechanisms demonstrate how governance contributes to sustainable value creation. A further subtopic is culture, ethics, values, and remuneration. The framework emphasizes how organizational values are reflected in the use of and effects on the capitals, stakeholder relationships, and remuneration systems. Incentives should be linked to value creation across the short, medium, and long term. Strong governance therefore serves as the foundation for accountability, integrity, and sustainable organizational success. Slide 14 is to 4C, Business Model. This slide introduces the business model, which lies at the heart of value creation within the integrated reporting framework. The business model explains how an organization transforms resources into outputs and outcomes that support its strategic objectives and long-term sustainability. The principal topic is business model definition. The framework defines a business model as the system through which an organization transforms inputs, via business activities, into outputs and outcomes that create value over time. It is therefore the central mechanism through which value creation occurs. A significant subtopic is inputs. Inputs comprise the capitals upon which the organization depends and which contribute materially to value creation. These capitals may or may not be owned by the organization, but they are essential for achieving strategic objectives. Another important subtopic is business activities. These activities explain how the organization differentiates itself in the marketplace, drives innovation, adapts to change, develops employee capabilities, improves processes, and manages stakeholder relationships. A further subtopic is outputs and outcomes. Outputs include products, services, byproducts, waste, and emissions generated by organizational activities. Outcomes represent the broader internal and external consequences, both positive and negative, on the capitals. These outcomes provide a more complete understanding of value creation than outputs alone. The business model therefore serves as a powerful framework for explaining how organizations transform resources into sustainable value. Slide 15, Business Model, Outputs versus Outcomes, an illustration. This slide elaborates on the distinction between outputs and outcomes, an essential concept within the business model. Understanding this distinction enables stakeholders to appreciate the broader impacts of organizational activities on value creation. The principal topic is outputs versus outcomes. Outputs represent the direct products and services generated by organizational activities, whereas outcomes refer to the broader consequences of those outputs on the capitals and stakeholders. Outcomes can be positive or negative and may affect both the organization and society. A significant subtopic is positive outcomes. The framework provides examples such as increased financial capital through profits, shareholder dividends, tax contributions, and enhanced social and relationship capital resulting from stronger brand reputation, customer satisfaction, innovation, and product quality. These outcomes contribute positively to long-term value creation. Another important subtopic is negative outcomes. Organizational activities may also generate adverse consequences, including depletion of natural capital through fossil fuel consumption or environmental degradation, and reductions in social and relationship capital arising from stakeholder concerns regarding health, environmental, or social impacts. A further subtopic is multiple business models and complexity management. Some organizations operate multiple business models simultaneously. The framework recommends disaggregating material business activities while balancing transparency and complexity. Material information should never be omitted merely to simplify reporting. This balanced perspective enables stakeholders to understand both the benefits and consequences of organizational value creation activities. Slide 16 is to 4D, Risks and Opportunities. This slide addresses risks and opportunities, a critical content element that explains the uncertainties and potential advantages influencing an organization's ability to create value over time. Integrated reporting requires organizations to identify not only threats but also opportunities that may enhance future performance. The principal topic is identifying key risks and opportunities. Organizations should disclose risks and opportunities that materially affect value creation and relate to the availability, quality, affordability, and impacts of the capitals. A major subtopic is sources of risks and opportunities. These may originate from internal organizational activities, external environmental conditions, or a combination of both. External influences include market changes, regulation, technology, and stakeholder expectations, while internal sources include operational processes and strategic decisions. Another important subtopic is likelihood and magnitude assessment. Organizations should assess both the probability that risks or opportunities will materialize and the magnitude of their potential effects. Such assessments inevitably involve uncertainty and require professional judgment. A further subtopic is mitigation and value creation actions. Organizations should disclose the strategies, policies, targets, KPIs, and management actions used to mitigate risks or capitalize on opportunities. This demonstrates preparedness and strategic responsiveness. The framework also emphasizes disclosure of low probability but potentially catastrophic risks that could fundamentally threaten organizational value creation. Slide 17 is to 4E, Strategy and Resource Allocation. This slide examines strategy and resource allocation, which addresses the question, where does the organization want to go and how does it intend to get there? This content element connects vision, objectives, resource deployment, and value creation. The principal topic is strategic direction and objectives. Organizations should identify their short, medium, and long-term strategic objectives, the strategies designed to achieve them, and the resource allocation plans supporting implementation. These disclosures help stakeholders understand organizational priorities and future direction. A significant subtopic is linkage with other content elements. Strategy should be explained in relation to the business model, external environment, risks and opportunities, capitals, and governance arrangements. This demonstrates the connectivity of information central to integrated reporting. Another important subtopic is competitive differentiation and innovation. Organizations should explain what differentiates them from competitors, including innovation capabilities, intellectual capital development, and the integration of environmental and social considerations into strategic planning. A further subtopic is stakeholder engagement findings. The framework encourages organizations to explain how stakeholder insights influence strategic decisions and resource allocation plans. Such disclosures demonstrate responsiveness and accountability. Effective strategy and resource allocation therefore provide a roadmap for achieving sustainable value creation and organizational resilience. Slide 18 is to 4F, Performance. This slide focuses on performance, which evaluates the extent to which an organization has achieved its strategic objectives and how its activities have affected the capitals. Performance reporting provides evidence of whether strategies and resource allocation decisions are delivering the intended outcomes. The principal topic is measuring strategic achievement. An integrated report should explain the extent to which strategic objectives have been achieved during the reporting period. This assessment should be supported by both qualitative and quantitative information. A significant subtopic is quantitative indicators. Organizations should present relevant performance indicators linked to targets, risks, and opportunities. These indicators should explain their significance, underlying assumptions, and implications for value creation. Another important subtopic is effects on the capitals. Performance reporting should include positive and negative impacts on all relevant capitals, including impacts occurring throughout the value chain. This provides a holistic view of organizational outcomes. A further subtopic is stakeholder relationships and linkages across time. Organizations should disclose the status of key stakeholder relationships and explain connections between past performance, current achievements, and future outlook. Such disclosures enhance transparency and support informed decision-making. The framework also encourages the use of integrated KPIs that connect financial and non-financial performance, demonstrating the interdependence of multiple capitals and long-term value creation. Slide 19 is to 4G, Outlook. This slide focuses on outlook, a critical content element that addresses the question, what challenges and uncertainties is the organization likely to encounter in pursuing its strategy, and what are the potential implications for its business model and future performance? The Outlook section provides stakeholders with a forward-looking perspective on the organization's preparedness, adaptability, and long-term resilience. The principal topic is future challenges and uncertainties. The framework requires organizations to identify anticipated changes in the external environment and explain how these developments may influence future performance. Such disclosures enable stakeholders to assess the organization's readiness to respond to emerging trends and disruptions. A significant subtopic is external environment and strategic implications. Organizations should explain how economic, technological, environmental, social, political, and regulatory developments may affect their business model and strategic objectives. These disclosures strengthen stakeholder understanding of future risks and opportunities. Another important subtopic is availability, quality, and affordability of capitals. The framework recognizes that future value creation depends on continued access to key capitals. Organizations should therefore discuss factors that may affect the availability or quality of these capitals over time. A further subtopic is forecasts, KPIs, and sensitivity analysis. Organizations may provide leading indicators, targets, objectives, forecasts, projections, and sensitivity analyses supported by transparent assumptions. These disclosures help stakeholders evaluate the plausibility of future expectations. The Outlook section therefore strengthens strategic transparency and demonstrates organizational preparedness for future challenges and opportunities. Slide 20 is to 4H, Basis of Preparation and Presentation. This slide introduces basis of preparation and presentation, the final content element of the framework. It explains how organizations determine what information is included in an integrated report and how that information is measured, evaluated, and presented. The principal topic is basis of preparation and presentation. Organizations should clearly explain the methodologies, assumptions, frameworks, and processes used in preparing the integrated report. Such transparency enhances credibility, comparability, and stakeholder confidence. A significant subtopic is materiality determination summary. Organizations should provide a concise description of the process used to identify relevant matters, evaluate their significance, prioritize material issues, and determine disclosures. The report should also explain the roles of governance bodies and key management personnel in this process. Another important subtopic is reporting boundary. Organizations should identify and explain the reporting boundary used within the integrated report. Where limitations exist due to data availability, control issues, or reporting constraints, these limitations should be transparently disclosed together with actions being taken to address them. A further subtopic is frameworks and evaluation methods. The framework requires organizations to disclose significant standards, methodologies, formulas, and evaluation techniques used to quantify or assess material matters. Consistency with financial and sustainability reporting systems is encouraged wherever appropriate. This content element enhances transparency and enables stakeholders to better understand the reliability and basis of reported information. Slide 21, Chapter 5 General Reporting Guidance, Overview. This slide introduces Chapter 5, General Reporting Guidance, which provides supplementary guidance applicable across multiple content elements of an integrated report. These provisions help organizations improve the quality, consistency, and effectiveness of disclosures. The principal topic is General Reporting Guidance. While the guiding principles and content elements establish the core structure of integrated reporting, Chapter 5 provides additional guidance regarding how material matters, capitals, reporting periods, and information aggregation should be addressed. A significant subtopic is disclosure of material matters. Organizations should ensure that material matters are disclosed in a manner that clearly explains their significance, impacts, management responses, and implications for value creation. Another important subtopic is disclosures about the capitals. The framework emphasizes the importance of explaining how capitals are used, transformed, increased, decreased, or affected through organizational activities and decision-making. A further subtopic is time frames for short, medium, and long term. Organizations should define reporting horizons that reflect their business model, investment cycle, strategic planning processes, and stakeholder expectations. The final subtopic is aggregation and disaggregation. The framework encourages organizations to present information at an appropriate level of detail, balancing clarity, relevance, and completeness. Collectively, these reporting guidance provisions strengthen the quality, usefulness, and credibility of integrated reports. Slide 22. Disclosure of material matters. This slide focuses on disclosure of material matters, which provides guidance regarding how organizations should communicate material issues affecting value creation. Effective disclosure ensures that stakeholders receive decision-useful information regarding matters of strategic significance. The principal topic is key information about material matters. Organizations should explain the nature of each material matter, its effect on strategy, business model, and capitals, as well as the relationships and interdependencies that influence outcomes. These disclosures should also include management's perspective and actions taken to address the issue. A significant subtopic is management response and control. Integrated reports should explain how material matters are managed, the effectiveness of actions taken, and the extent to which the organization can influence outcomes. This demonstrates accountability and strategic responsiveness. Another important subtopic is uncertainty disclosures. Organizations should describe uncertainties, possible outcomes, underlying assumptions, and the degree of confidence associated with disclosed information. Such transparency helps stakeholders understand the limitations and variability of future expectations. A further subtopic is competitive sensitivity and practical considerations. Where information cannot be determined or where detailed disclosure would significantly undermine competitive advantage, organizations should explain the circumstances and provide general information where possible. The framework emphasizes that disclosures should be specific, relevant, and useful rather than generic or boilerplate in nature. Slide 23. Characteristics of quantitative indicators, Section 5.5. This slide examines the characteristics of quantitative indicators, highlighting the role of key performance indicators, KPIs, in enhancing the usefulness, comparability, and accountability of integrated reporting. Quantitative indicators provide objective evidence supporting narrative disclosures. The principal topic is role of quantitative indicators. KPIs help organizations communicate performance against objectives, targets, risks, opportunities, and strategic priorities. They enable stakeholders to assess progress and compare performance over time. A significant subtopic is relevance and consistency. Indicators should be directly relevant to organizational circumstances and aligned with measures used internally by management and those charged with governance. This strengthens connectivity between internal management and external reporting. Another important subtopic is connectivity and focus. Quantitative indicators should demonstrate relationships between financial and non-financial performance and focus on matters identified through the materiality determination process. A further subtopic is trend analysis and future orientation. Indicators should be presented over multiple reporting periods and accompanied by targets, forecasts, or projections to help stakeholders understand trends and future expectations. The final subtopic is benchmarking and accountability. Organizations should use recognized industry benchmarks where possible and report performance consistently, regardless of whether trends are positive or negative. Such practices enhance comparability and accountability. Quantitative indicators therefore serve as an important bridge between strategy, performance, and value creation. Slide 24. Disclosures about the capitals, Section 5.6. This slide focuses on disclosures about the capitals, providing guidance on how organizations should report their use of, dependence on, and impacts upon the 6 capitals. The objective is to explain how capitals contribute to value creation and long-term sustainability. The principal topic is determining capital disclosures. The framework requires organizations to disclose information about capitals based on their significance to value creation rather than ownership. Disclosures should explain factors affecting the availability, quality, affordability, and future utility of capitals. A significant subtopic is qualitative and quantitative capital information. While quantitative data are valuable, the framework recognizes that not all capital movements can be meaningfully measured. Organizations should therefore provide qualitative explanations where quantification is impractical or inappropriate. Another important subtopic is interdependencies among capitals. The framework does not require exhaustive measurement of all capital interactions. However, organizations should explain important interdependencies, relationships, and trade-offs that influence value creation. A further subtopic is trade-offs between capitals and overtime. Examples include creating employment opportunities while affecting environmental quality, or accepting lower short-term returns to generate greater long-term value. Such trade-offs are important considerations in sustainable value creation. By explaining capital interdependencies and trade-offs, organizations provide stakeholders with a richer understanding of how value is created, preserved, and sustained over time. Slide 25. Time frames for short, medium and long term, section 5.9-5.11. This slide focuses on time frames for short, medium and long term, an important consideration within integrated reporting because value creation occurs across multiple time horizons. The framework recognizes that organizations create value through decisions whose impacts may emerge immediately, gradually, or over extended periods. Consequently, integrated reporting adopts a broader time perspective than many conventional reporting approaches. The principal topic is determining appropriate time horizons. The framework does not prescribe fixed definitions for short, medium, or long-term periods. Instead, organizations determine these horizons according to their business model, investment cycles, strategic objectives, industry characteristics, and stakeholder expectations. This flexibility ensures that reporting remains relevant to organizational circumstances. A significant subtopic is industry-specific differences. Reporting time horizons differ considerably across sectors. For example, strategic planning cycles in capital-intensive industries may extend over several years, whereas technology-based industries often operate within much shorter innovation and investment cycles. Similarly, environmental and social impacts may extend far beyond traditional financial planning periods. Another important subtopic is implications for disclosure quality. Longer-term issues are generally associated with greater uncertainty and therefore may require qualitative disclosures, scenario analysis, and strategic narratives. Conversely, shorter-term issues are often more suitable for quantitative measurement and monetization. The framework therefore encourages organizations to adopt reporting horizons that accurately reflect their value creation journey while ensuring transparency regarding assumptions, uncertainties, and future expectations. Slide 26. Aggregation and Disaggregation, Section 5.12-5.14. This slide addresses aggregation and disaggregation, which concerns the level of detail at which information is presented within an integrated report. Effective reporting requires organizations to strike an appropriate balance between providing meaningful detail and maintaining overall clarity and conciseness. The principal topic is determining the appropriate level of information. Organizations must decide whether information should be presented in aggregated or disaggregated form based on its relevance and usefulness. Reporting may be organized by country, subsidiary, business division, operational site, product category, or geographic segment depending on organizational circumstances. A significant subtopic is balancing clarity and completeness. Excessive aggregation can obscure important differences in performance and prevent stakeholders from identifying significant risks, opportunities, or operational variations. Conversely, excessive disaggregation can create information overload, reducing readability and stakeholder understanding. Another important subtopic is alignment with management oversight. The framework encourages organizations to align reporting structures with the way senior management and governance bodies monitor, evaluate, and oversee organizational activities. This ensures consistency between internal decision-making and external communication. A further subtopic is business and geographic segmentation. Information is commonly presented according to business units or geographic segments used for financial reporting purposes, thereby enhancing comparability and coherence across disclosures. Through appropriate aggregation and disaggregation, organizations improve transparency, stakeholder understanding, and the overall effectiveness of integrated reporting. Slide 27. Summary of requirements. Using the framework. This slide summarizes the key requirements associated with using the International Integrated Reporting Framework. These requirements reinforce the integrity, consistency, and credibility of integrated reporting and ensure that organizations apply the framework appropriately. The principal topic is form of report. The framework requires an integrated report to be a clearly designated and identifiable communication. Stakeholders should be able to recognize the integrated report as a distinct communication focused on value creation. A significant subtopic is application of framework requirements. Any communication claiming to be an integrated report must comply with all mandatory requirements identified within the framework, except where reliable information is unavailable, legal restrictions apply, or disclosure would result in significant competitive harm. Another important subtopic is disclosure of omissions. Where material information is omitted, organizations should explain the nature of the omitted information, the reasons for omission, actions being taken to obtain the information, and the expected time frame for future disclosure. This promotes transparency and accountability. A further subtopic is governance responsibility. Integrated reports should contain a statement from those charged with governance acknowledging responsibility for ensuring the integrity of the report and providing their opinion regarding compliance with the framework. These requirements collectively reinforce stakeholder trust and ensure that integrated reports remain credible, transparent, and aligned with international reporting expectations. Slide 28. Guiding Principles and Content Elements. This final slide provides a consolidated summary of the 7 guiding principles and 8 content elements, which together constitute the foundation of the International Integrated Reporting Framework. The slide serves as a comprehensive recap of the concepts covered throughout this chapter and highlights their collective contribution to value-oriented reporting. The first principal topic is the 7 guiding principles. These include strategic focus and future orientation, connectivity of information, stakeholder relationships, materiality, conciseness, reliability and completeness, and consistency and comparability. Collectively, these principles determine the quality, structure, relevance, and usefulness of integrated reporting disclosures. The second principal topic is the 8 content elements. These content elements answer critical questions regarding organizational purpose, governance, business model, risks and opportunities, strategy and resource allocation, performance, outlook, and basis of preparation and presentation. Together, they provide a comprehensive explanation of how organizations create, preserve, or erode value over time. A significant subtopic is connectivity between principles and content elements. The guiding principles influence how information is selected, structured, and presented, while the content elements determine the substantive information included within the report. Their integration ensures that reporting remains coherent, balanced, and stakeholder-focused. Ultimately, the framework encourages organizations to move beyond traditional reporting boundaries and adopt a holistic perspective that integrates financial, governance, sustainability, and strategic information. Through this approach, integrated reporting enhances transparency, accountability, decision-making quality, stakeholder trust, and long-term value creation. Here we end this presentation series on integrated reporting, international framework which globally recognized framework that seeks to transform the way organizations communicate value creation. Overall, integrated reporting promotes integrated thinking, better decision-making, stakeholder trust, and sustainable value creation. In the coming week we shall move to a new series on impact and SDG-oriented frameworks. So stay tuned with our channel, as we encourage you to remain actively engaged with our channel, participate in the forthcoming sessions in continuing this topic related to various types of risk associated in sustainable disclosures, and thoughtfully disseminate these professional insights across your networks, particularly among business leaders, sustainability practitioners, compliance professionals, and stakeholders committed to advancing responsible corporate governance and transparent reporting practices.